Welcome to The Explainer. Today, we're essentially putting on our scrubs and conducting a full medical-style diagnostic on a seriously complex financial document. You know, if you've ever stared at a corporate earnings report and felt like you were trying to read an entirely different language, trust me, you are absolutely not alone. But today, we're going to translate all that dense jargon, check the vital signs, and get a really clear, impartial look at the financial health of a major player in the commercial real estate space. Let's get into it. Everything we're diagnosing today comes straight from the source. We're looking at Arbor Realty Trust's official Form 10-Q filing with the SEC for the second quarter of 2026. So, no speculation here. This is the raw, unfiltered financial truth that they submitted to the government. It's hundreds of pages long, it's incredibly dense, but honestly, it holds all the answers we need to understand exactly how this company is navigating a pretty wild real estate environment right now. Okay, let's dive into this, because we have a central mystery today, and it starts with a very specific number. Negative $30.1 million. That's the net loss Arbor Realty Trust posted for this quarter. But, and here's the truly fascinating part, this is a company that is still bringing in massive amounts of revenue. So how exactly does a financial engine that's generating hundreds of millions of dollars still end up in the red? That's exactly what we're going to figure out. Here is our roadmap for today's health check. First, we'll meet Arbor Realty Trust. Then, check the Q2 vitals and headline numbers. Third, we'll unpack that net loss. Fourth, we'll look at assets, liabilities, and liquidity. Fifth, we'll go inside the loan portfolio. And finally, we'll wrap up with the big takeaways. All right, starting with Section 1, Meet Arbor Realty Trust. Let's get our baseline profile.
So Arbor Realty Trust is what we call a REIT, which stands for Real Estate Investment Trust. Basically, think of a REIT as a company that lets everyday folks invest in large-scale, income-producing real estate without having to, go out and buy an entire apartment complex themselves. Arbor operates with a really interesting dual-engine business model. On one side, you've got their structured business. That's where they act as a direct lender and investor, mostly in the multifamily and commercial real estate markets. And then on the other side, there's their agency business. This is where they originate, sell, and service loans through government-sponsored enterprises. Think Fannie Mae and Freddie Mac. It's a highly sophisticated, two-pronged approach to real estate finance.
Moving right along to Section 2, Q2 vitals and headline numbers. Let's check the pulse here. For a lending institution like Arbor, interest income is literally their lifeblood, and the numbers here are really telling. Back in Q2 of 2025, they generated $240.3 million in interest income. Fast forward to Q2 of 2026, and that number is at $230.8 million. Now, sure, it's slightly down year over year, but come on, that is still a remarkably robust figure. The money is absolutely still flowing in through the front door. But here's where the vitals take a really jarring turn. Despite bringing in nearly $231 million in interest, their bottom line, meaning the actual profit left over after all the expenses, just completely fell off a cliff. In Q2 of 2025, they posted a very healthy net income of $36.3 million. But in Q2 2026, a net loss of $30.1 million. We are talking about a massive, nearly $66 million swing into the negative here. The revenue is obviously there, so something deep inside those expense columns is aggressively eating away at their profits. Which brings us perfectly to Section 3, Unpacking the Net Loss. Time to play forensic accountant and find the root cause. Now, what's really interesting about this is exactly where these losses live in the official paperwork. We're looking at the Consolidated Statement of Operations, which is basically the company's ultimate profit and loss statement. If you scan down past all that revenue we just talked about, you hit the other expenses category. Total other expenses jumped from $91.9 million last year to an eye-watering $144.8 million this year. Let's break down exactly what's driving that massive spike. By extracting the data directly from that complex document, we can isolate the exact symptoms driving this net loss. It really comes down to two specific line items. First up, the provision for credit losses. In Q2 of 2025, this sat at $19 million. In Q2 of 2026, it essentially doubled to $38.1 million. Next, take a look at the impairment loss on real estate owned. Last year, $0. This year, $13.6 million. These two items alone account for over $32 million of brand new expenses compared to the exact same time last year. So, Let's translate that accounting jargon into plain English. A provision for credit losses doesn't actually mean cash is physically leaving the bank today. It's essentially management setting aside a massive rainy day fund. They're looking at the current economic conditions and acknowledging, hey, some of the people we loaned money to might not be able to pay us back. Because they have to be cautious, they deduct that anticipated loss from today's profits. That right there explains the $38.1 million hit. Then you have the impairment loss of $13.6 million. That just means some of the actual physical real estate the company ended up owning has dropped in value and they had to officially write down that loss on their books. It's protective accounting, sure, but it absolutely crushes their quarterly net income. Let's pivot over to Section 4, Assets, Liabilities, and Liquidity. We're checking the bone structure now. To see how solid their foundation is, we have to look at the consolidated balance sheets. While the income statement we just looked at shows a specific 3-month window, the balance sheet is more like a snapshot of everything the company owns and owes at one very specific moment in time. We always look right at the very top of the assets column because that tells us about their immediate liquidity. Ultimately, we want to know how much cash do they have on hand to weather this storm, because at the end of the day, cash is the oxygen for any business.
And the data here shows a pretty noticeable drop. At the end of 2025, Arbor had $482.8 million in cash and cash equivalents. Just 6 months later, at the end of Q2 2026, that number had fallen to $287.5 million. Now, from a purely objective standpoint, seeing your cash reserves drop by roughly 40% in half a year is definitely a red flag you have to monitor. But to be completely impartial here, having over $287 million in pure cash is still a very substantial cushion to fall back on. Plus, if you really dig into the filings, their restricted cash, which is cash held aside for specific purposes, actually increased from $67 million to $138 million. So while their free cash is down, the company is certainly not running on empty.
All right, let's move on to Section 5, Inside the Loan Portfolio. Time to examine the diet. Now, before we look at the portfolio itself, we really need to understand one vital term, the bridge loan. A bridge loan is, well, exactly what it sounds like. It's short-term financing designed to bridge a gap. Real estate investors use these loans to buy a property and fix it up, with the intention of eventually getting a traditional long-term mortgage once the property is stabilized and actually making money. Because of their nature, they are inherently much shorter term and carry very different risks than your standard 30-year fixed mortgage. And this brilliantly illustrates exactly where Arbor's exposure lies. When we look at their $12.1 billion structured business loan portfolio, it is not highly diversified across a bunch of different loan types. A staggering 93% of their entire portfolio consists of these short-term bridge loans. We're talking over $11.3 billion tied up in transitional financing. Things like mezzanine loans, construction loans, and preferred equity, they make up just tiny little slivers of the remaining pie. And if you read the fine print in the footnotes of the 10Q, you find another really fascinating layer of detail. Out of that massive bridge loan portfolio, Arbor is carrying 176 bridge loans specifically dedicated to single-family rentals, or SFRs. So we're not talking about giant apartment skyscrapers here. These are portfolios of individual houses meant for renting. Arbor currently has $3.38 billion actively funded just in this one specific property type. It really highlights a highly concentrated, targeted investment strategy. We've reviewed the vitals, we've analyzed the anatomy. Let's move to Section 6, the big takeaways, our final prognosis.
So the crucial point here is that Arbor Realty Trust presents a pretty mixed chart. On the green flag side, top-line interest income is incredibly robust at nearly $231 million. The core engine of the business is definitely running. However, on the red flag side, the bottom line was severely impacted by massive rainy day funds for credit losses and devalued properties. We also saw their immediate cash liquidity drop, though it totally remains sufficient to operate. And importantly, 93% of their entire portfolio is heavily concentrated in short-term bridge loans.
Which leaves us with this final thought. When you really understand the data, the true question isn't just about what happened this past quarter. It's about what happens next. In an unpredictable economic climate, where interest rates are fluctuating and property values are constantly shifting, how will a company with over $11.3 billion tied up in short-term bridge financing navigate the months ahead? Will those massive rainy day funds they set aside be enough, or will they need to brace for an even heavier storm? Well, that's something you now have the exact tools to watch closely in their next filing. Thank you so much for joining me on this explainer. Keep your curiosity sharp, and I will see you next time.